Welcome to the deep dive. Today we're tackling, well, a really high-stakes topic, critical minerals.
And specifically one company that's been making huge waves.
Exactly. USA Rare Earth, ticker USR. We're asking the big question, is it actually a good investment? I mean, the stock's performance is just mind-blowing. Shares closed recently around $33.68.
Yeah, the returns.
Yeah, up over 145% in just the last month. And get this, over 213% in the last year.
That's incredible momentum. Usually suggests a very profitable company.
You'd think so. But here's the kicker. USR is pre-revenue. They haven't actually sold anything yet.
And that right there is why we need this deep dive for you. It's a classic case of market hype versus potential reality. Our mission today is to look past that stock surge. We need to dig into USR's potential intrinsic value.
So examine the strategy the market seems to be buying into.
And then really contrast that hard with the financials, the fundamentals, and figure out what that risk-reward picture truly looks like.
Okay, so let's start unpacking that 213% gain. For a company with no sales, something big must be driving it.
It's definitely not your standard commercial story.
No, this feels different. It's about strategy, geopolitics, national security, almost.
Absolutely.
Yeah.
So you have to understand the global context here. The U.S. is incredibly dependent on China for these critical minerals.
How dependent are we talking?
Well, for rare earths processing, China controls over 80% globally.
80%, wow.
And it gets worse further down the chain. For the actual high-performance magnets made from these rare earths, China's got over 90% of that market.
90%. That's basically a monopoly, a huge strategic vulnerability.
Precisely. And the demand for these things isn't slowing down, it's accelerating.
Right, because we need them for everything in the green transition, right? EVs, wind turbines.
Exactly. The energy sector is a massive driver. Think high-efficiency EV motors, those giant magnets and wind turbines. Plus, sophisticated defense systems rely on them too. Demand forecasts are huge, maybe 50 to 60% growth by 2040, even in conservative scenarios.
So recognizing this massive dependency, the U.S. government is stepping in big time.
Yeah, there's significant government backing now, creating a real tailwind for domestic companies like USR.
Like the Department of Energy's billion-dollar initiative for critical minerals funding.
That's part of it. But it's more than just grants. Look at the Department of Defense, the DoD.
What have they done?
They gave a $150 million loan to MP Materials, which is a peer company, to help boost domestic production.
Okay, so direct financial support.
Yes, but crucially, they also did something else. They set a price floor.
A price floor? For what?
For NdPr, that's neodymium praseodymium, the key elements in standard high-performance magnets. They set it at $110 per kilogram.
Okay, hold on. Why would the government set a minimum price? What does that achieve for, say, USR?
It's basically strategic insurance. The big fear for any new domestic player is that China could just dump cheap rare earths onto the market and crush them before they even get started.
Ah, predatory pricing.
Exactly. So this price floor guarantees a minimum price, protecting USR and others from those kinds of aggressive tactics. It makes investing domestically much less risky.
Got it. That makes sense.
And don't forget the tariffs. There's a 25% tariff on Chinese rare earth magnets set to start in 2026.
So USR's future magnets will automatically be more competitive against Chinese imports.
Right. It's a significant regulatory advantage baked in.
Okay, so this whole environment sets the stage for USR's big plan, their mines to magnets strategy.
Very ambitious. They're aiming for a completely vertically integrated all-American supply chain.
Built on 4 pillars, they say. The first one, and the key near-term piece, is magnet manufacturing.
Correct. They're building a big facility, 310,000 square feet, in Stillwater, Oklahoma.
And when's that supposed to be ready?
They're targeting commissioning in the first quarter of 2026, starting at 1,200 metric tons per year capacity, hoping to scale up to 5,000 eventually.
That's the part that could actually generate revenue soon.
That's the hope. It's the cornerstone of their short-term story.
Okay, pillar 2 is metal making, turning the processed oxides into metals. They need domestic capacity for that too, right?
They do. Currently, they're planning on interim offtake deals, likely buying metal while they develop their own capability. That's a bit further out.
Pillar 3, processing and separation, getting the individual rare earths out of the ore.
Yeah, they have an R&D facility in Wheat Ridge, Colorado. They're focused on a tech called Continuous Ion Exchange, or CIE.
And they've had some success there.
They have. They announced a technical milestone producing a dysprosium oxide sample that was 99.1% pure.
Why is that specific achievement important?
Well, dysprosium is one of those critical heavy rare earths,
Yeah.
and 99.1% purity is a good result. Also, the CIE technology itself is promising potentially faster and cleaner than the traditional solvent extraction methods China mostly uses. It could be competitive edge if they scale it.
Okay, and the final pillar, the foundation for everything long-term, mining,
Right. This relies on their control of the Round Top Mountain deposit in West Texas.
which is described as the largest U.S. deposit of heavy rare earth elements.
Exactly. And that heavy part, the HREs, is incredibly important. That's USR's key strategic differentiator.
Why are heavy rare earths like dysprosium and terbium so special?
Because they allow magnets to maintain their strength at high temperatures. Think about an EV motor spinning incredibly fast, or components in aerospace or defense systems operating under extreme conditions.
Okay, so they're essential for high-performance stuff.
Absolutely mandatory. And China's control over refining these specific HREs is particularly tight. So Round Top isn't just another rare earth deposit, it's potentially a unique, irreplaceable domestic source for these critical heavy elements.
Giving the U.S. a capability it currently lacks.
Precisely. It's a major strategic asset if they can develop it.
All right, so the strategic story sounds compelling. Government backing, unique resource, clear plan.
It paints a very attractive picture, strategically speaking.
But strategy costs money. A lot of money, I imagine. Let's pivot now and crack open that balance sheet. This is where it gets complicated, right?
Yeah, let's anchor ourselves in the financial facts as of, say, Q2 2025. First off, as we said, pre-revenue, zero sales.
Okay. And profits.
Well, no revenue means no profit. They reported a Q2 net loss of $142.7 million.
Ouch. A big loss. What about cash? Are they out to run out?
Actually, their cash position is pretty strong for now. They had $121.8 million in cash reserves, and importantly, no significant debt.
Okay, so they have some runway, but what about the balance sheet overall? Assets versus liabilities.
That's where it looks less conventional. They reported negative shareholder equity of $131.9 million as of June 30th, 2025.
Negative equity, meaning liabilities are greater than assets. That gives them a negative book value, right?
Correct. And a price-to-book ratio that's deeply negative, around negative 24.45x.
Normally, negative book value is a massive red flag for investors. Like, the company is technically worth less than nothing on paper.
In a traditional business, absolutely. But
Yeah.
here, the market is interpreting it differently.
Yes.
Investors aren't valuing USR based on its current assets or lack thereof. They're valuing the future potential, the strategic narrative. That $1.42 billion market cap we saw earlier compared to the negative book value, that huge gap is the premium the market is paying for the story, for the promise of that mines to magnets secure domestic supply chain.
So they're valuing it almost like a defense contractor solving a national security problem, not just a mining company.
Sort of, yes. The market is betting heavily on future execution and strategic importance, largely ignoring the current accounting picture.
Okay, this massive disconnect between the story and the current financials explains why we see such wildly different valuations from analysts, right?
Exactly. There's a huge divide. On the optimistic side, you have models like a discounted cash flow or DCF analysis from Simply Wallcent back in October 2025.
What did that bull case show?
It projected a really dramatic turnaround, forecasting positive free cash flow hitting $122.6 million by 2029. Based on that, they estimated an intrinsic value of $79.40 per share.
$79. Compared to the current price, around $33, that suggests it's massively undervalued.
By over 57%, according to that specific optimistic model.
Wow. Okay, but then there's the other side, the skepticism.
Right. You have models, like one from Stock Analytics AI, that take a much more cautious view.
What drives their lower valuation? What are they focusing on?
Primarily, execution risk. They emphasize how incredibly difficult, expensive, and time-consuming it is to actually build everything USR plans to build. The processing plants, the magnet facility.
So they factor in a higher chance of things going wrong, delays, cost overruns.
Precisely. They use a much higher discount rate in their models, maybe 15 to 20%, to account for that risk. And when you apply that kind of discount, the intrinsic value estimate drops dramatically.
How low are we talking?
Their model suggests a range of maybe $10 to $18 per share.
$10 to $18. That's a world away from $79.
A huge difference. And it's worth noting, too, the consensus among the few analysts covering the stock. Their average 12-month price target is only $16.
$16, so closer to the skeptical view than the optimistic one.
Yeah.
Okay, so let's recap the valuation picture. We have a bull case seeing value near $80, A bear case saying maybe $10 to $18, analyst consensus at $16, and the stock is actually trading right in the middle, around $33, $34.
Exactly. What that tells us is the market is kind of splitting the difference. It's pricing in, let's say, a fair degree of success.
Meaning investors believe USR will probably pull some of this off. They trust the asset, the strategy.
But they're also heavily acknowledging the significant risk.
Mhm.
They know building an entire supply chain like this from scratch, facing down China, is incredibly hard, and failure is a real possibility. The current price reflects that tension between huge potential and huge risk. So let's dig into those risks properly. The bear case. Number one, as we just discussed, is execution risk.
Just the sheer difficulty of building all this stuff on time and on budget.
It's immense. We're talking complex chemical processing, advanced manufacturing. It's like trying to build a rocket ship in your garage. Delays and cost overruns are almost inevitable. That first quarter 2026 target for the Stillwater magnet facility, very ambitious.
And even with $121 million in cash, that won't be enough for the whole plan, will it? Which brings up capital fragility.
Right. They are burning cash. Q2 free cash flow is negative $31.5 million. They're absolutely dependent on raising more money, a lot more money, to fund construction and development. If capital markets tighten or they hit setbacks, funding could dry up.
Okay, risk 3, competition and market power. Basically, China.
Yeah, China isn't just going to roll over. They dominate the market. They have economies of scale, massive state backing. They could potentially use their market power to influence prices and make life very difficult for newcomers like USR.
And the last big risk seems tied to the first point we made, the geopolitical angle. Geopolitical dependency.
Absolutely. A huge part of USR's value proposition is tied to the current U.S.-China tensions and the push for supply chain security.
So if relations suddenly improved, a major trade deal, some kind of strategic reset.
Then the urgency behind domestic supply chains might lessen. Government incentives could potentially soften. The core strategic driver for USR could weaken significantly. Its value is linked to the current geopolitical climate.
Okay, those are some serious risks. But what about the upside, the bull case arguments?
Well, they are equally compelling in their own way. First, look at anchor customers.
You mean the partnerships they've announced?
Exactly. They've signed 12 memorandums of understanding, MOUs, and joint development agreements, JDAs. These cover potential demand for about 300 tons of annual production.
Who are these potential customers?
Big names across key sectors. Defense contractors, aerospace companies like Polar Star, automotive players, even tech. They have an MOU with Apple.
Wait, but an MOU, that's a memorandum of understanding. It's not a firm purchase order, is it? It's more like an agreement to talk.
That's a crucial distinction, you're right. MOUs aren't guaranteed revenue. They are signals of intent. But what they do validate is that serious players want a non-Chinese source for these critical magnets.
So it shows the demand is real, even if the contracts aren't signed yet.
Precisely. And that leads to the next point, the supply chain incentive. Commercial customers today have a really powerful non-financial reason to work with someone like USR, even if it costs more initially.
Geopolitical risk avoidance. They want a reliable supply they know won't get cut off by tensions with China.
Exactly. They're essentially paying a premium for stability and supply chain resilience. That's a powerful incentive you don't normally see.
And of course, the core asset itself, the Round Top HRE deposit.
It's unique, a large-scale domestic source of those critical heavy rare earths needed for high-performance applications. That's a strategic asset that can't easily be replicated.
Okay, and just quickly, what about the technical picture for the stock itself? How are traders viewing it?
Well, despite the volatility, the technicals have been looking pretty bullish, actually. As of late August 2025, the stock was trading well above its 50-day and 200-day moving averages.
Which traders often see as a positive sign.
Right. And short interest was moderate, around 6.1%. Not excessively high, suggesting traders weren't overwhelmingly betting against it at that point. So the technical sentiment seemed to lean positive, reinforcing the market's willingness to bet on the story for now. #HAG outro.
Okay, let's try to wrap this up. USR feels like a quintessential high-risk, high-reward play.
Definitely. It's a strategic bet, perfectly aligned with U.S. national policy goals. It possesses a potentially unique and valuable asset with those heavy rare earths at Round Top.
Well, it's facing this monumental execution challenge, building an entire complex industry almost from scratch.
While burning through cash and operating in a market utterly dominated by a powerful geopolitical rival, the risks are enormous.
So what's the single most important thing for potential investors or even just observers to watch in the near term? What's the key catalyst?
It's crystal clear. That Stillwater Magnet Facility commissioning date, early 2026.
Everything hinges on that.
Pretty much.
Right.
And they actually hit that target. Can they start producing magnets on schedule and ramp up production? Success there would validate the plan and could send the stock towards that optimistic $79 valuation.
And failure, delays, major problem.
Would reinforce the bear case, suggesting the execution risk is too high. That could easily push the stock back towards those lower $16 analyst targets, or even the $10, $18 skeptical range. Hitting that Q1 2026 milestone is absolutely critical.
All right. So final thought for you, our listener, to chew on. We've talked a lot about financial strategy risk, but underlying all this is the simple fact that the modern world runs on materials like rare earths. And we're seeing potential shortages looming for other critical materials too, like copper and lithium, maybe 30–40% deficits by 2035.
And the refining for many of these, especially rare earths, is highly concentrated geographically. That creates inherent vulnerability.
So the provocative question is, when you're making an investment decision in a company like USR, how much of a premium should you personally place on fixing that vulnerability? On supply chain resilience? On national sovereignty even?
Is it just about the potential profit? Or does the strategic imperative, the need for stability, justify paying a higher price and accepting greater risk?
Something to think about. That's all for this deep dive.